Yeah, we think we do kind of maintain this range-bound environment. I think one thing kind of helping to keep that cap on yields is this fear, or I shouldn't say fear, but really this view that if we see a more meaningful sell-off, that Treasury will become a lot more activist. We had the quarterly refunding announcement from Treasury yesterday. Even going into that, we had some people talking about, would they cut issuance? Would they increase the size of their buyback program? Those are both tools that the administration does have to push back down those longer end yields. So they haven't had to use them, but it's kind of, speak softly, carry a big stick. Okay. They've been able to keep the big stick off the table.
You and I know Friday, besides you picking the Patriots over the Seahawks, you and I know Friday, Blake, that there's going to come out gloom about your world. OMG, they're only going to issue T-bills. Are we going to see a shift in the makeup of the paper the government issues?
I think they're going to hold on to this focus that they've had on the front end. So if you remember kind of before the election, we had Bessent and Mirren and some of these administration officials kind of talking about, the fact that the administration was leaning very heavily on bills. Bills were kind of in that 20 to 23% of total outstanding type of range. They tend to target something under 20% for bills, but they've been maintaining above that for a while. And I do think that the Fed now is back in the market buying bills. That also allows them, they now have a very large price insensitive buyer in the market. So that does allow them, I think, to lean on bills a little bit longer than they would have otherwise before they have to start increasing the rest of the curve.
Kevin Warsh, Fed chair nominee. What's your view, or what's the view of the clients you talk to about what might be this changing the guard?
Well, I think what everybody's focused on are, first and foremost, his views on the balance sheet, on the Fed's balance sheet. I think there's a lot of questions about what he's really going to be able to get done on the rate side. Obviously, he must have at least kind of committed to cutting. We heard as much from Trump yesterday, who said, yes, I am under the impression that he is coming in and cutting rates. Wouldn't have got the job if he didn't say that. But his success on that front, a little bit questionable. So I think people are really focused on what he's going to do on the balance sheet. And that's what rates markets are really reacting to right now.
So what do you think, or what's the market telling you that the Fed may do?
Well, I think the market is rightly dismissing it a bit. So we saw those trades perform into the announcement. So, these trades that would benefit if the Fed did change their balance sheet policy. We saw those perform on the announcement, but very quickly kind of faded away. So I think markets are treating it with a bit of wariness. A lot of people have been pointing to what's going on in commodities and crypto and some of these things as a result of those balance sheet policies. But at least in my space and rate space, we've seen people being a bit dismissive of it.
Okay, I triangulate as an amateur, folks. Trust me, Blake Gwinn pro, Tom Keene amateur. I got a 10-year real yield range bound 190 something, 193 right now. I got a vanilla 210 curve. It's nudging a little steeper as well. And then as an old fart, I go to 30-year bonds. You don't remember when the 30-year bond was the benchmark. Do I need to worry about a 5% 30-year bond and new steepness in the curve?
We've tested that level many times, and it's held so far.
Yeah.
And that is one area where I do think this mindset that Treasury will become more activist if we see those yields sell off. That's one of the things we're looking at. Are 30s going to really poke through that 5% ceiling that we've seen hold multiple times? Are 10s going to go towards new highs, 485, 5%? Those are the kind of moves that I would expect Treasury to become a lot more active with their policies.
Looking at the world interest rate probability function on the Bloomberg Terminal WIRP.
You're trying to impress him.
Yeah, exactly. Well, he went to Rutgers. He stayed at product of the state of New Jersey.
I gave a lecture there once. I was intimidated. Yeah. They were so damn smart. It was like, are you kidding me?
It's good stuff there. Couple of rate cuts this year. Does that make sense to you?
It does, because I think what you always have to remember with market pricing, you're not pricing a modal or most likely outcome. You're pricing a balance of all the risk-weighted outcomes that could happen. And so when I think you look at that pricing and it says 2 cuts, it's not that the whole market's saying we think they're going to cut 2 times. It's that you still have this, let's call it a 10% probability that we go into a recession and the Fed has to cut 200 basis points. So I think markets are always having to account for that very long tail risk. You look at the other side of the ledger there, how much could they realistically hike this year? Nobody's expecting hikes. So if you look at that skewed distribution, it kind of makes sense that it's pulling the market pricing a little bit in that direction.
I got time for one more question. We got to get Robert Schiffman in here. Blake, and this is important. Every night, RBC Capital Markets has their symbol, that iconic history of the Royal Bank of Canada, on the Montreal Canadiens jersey. Should Cole Caulfield be on the U.S. Olympic hockey team?
You're going to out me here. I might lose my job here at RBC. I've been able to hide the fact that I know nothing about hockey from the Canadians for a very long time. I've been able to fake it up till now, and I think you're outing me here.
We'll have to get a beverage of our choice here to explain how exciting they are.
We'll talk Chiefs. We'll talk Kansas City Chiefs next time I'm on here.
Okay, good.